So what if I told you a government just, intentionally deleted its most lucrative tax brackets? Like no 28% slab, no 12% slab, just completely gone.
Right. I mean, most people would grab a calculator, look at those massive tax cuts, and immediately predict national bankruptcy.
Exactly. But you are not here for a basic calculator check today. We are treating this deep dive like an intensive, high-stakes war room briefing.
Yeah, we really have to, because we are going to show you why India's GST 2.0 isn't a revenue disaster at all. It is actually, well, a brilliant high-stakes architectural patch.
And a massive one, right, because GST 2.0 just went live on September 22, 2025.
Yes, strategically timed right before the festive season. And, the surface level story in the news is always about consumer relief. Cheaper cars, cheaper cement, that sort of thing.
Right, the stuff that makes good headlines.
Exactly. But if you want to truly understand the strategic architecture beneath those numbers, we really have to look deeper. I mean, this is a next generation reform agenda.
So we aren't just talking about a simple tax cut.
Not at all. We are talking about completely overhauling compliance, rewiring the fiscal balance, and really driving national economic growth from the ground up.
Okay, let's unpack this. Because to understand why GST 2.0 is such a massive deal right now, you have to look at the system we are upgrading from.
Right. The original 2017 rollout.
Yeah, think of the original July 2017 GST rollout as like the beta version of a massive national software deployment. It did something completely unprecedented.
Oh, absolutely. It took this highly fractured, chaotic web of state and central taxes and just forced them onto a unified platform.
But like any beta software, it had some major user-reported bugs. And GST 2.0 is the patch designed to fix those structural flaws.
That is actually a perfect way to frame it. I mean, the 2017 structure was revolutionary, but it was incredibly complex. We had a 5-slab system.
Right, it was 0, 5, 12, 18, and 28%, wasn't it?
Yeah, exactly. And when you have that many tiers, you immediately create mass distortions in the market.
Because suddenly the definition of a product becomes a legal battle.
Oh, totally. Businesses were spending way more time and money hiring lawyers to argue over which category their product belonged in than they were spending on, actual research and development.
Right, which just leads to a massive tsunami of classification disputes.
Yeah, the courts were flooded. And beyond the legal headaches, there was the compliance nightmare, specifically around something called input tax credit, or ITC.
ITC. That was a huge pain point for small businesses, right?
It was one of the most critical bugs in the 2017 system. Look, when businesses bought raw materials, they paid tax, which they were supposed to get back as credit once they sold the final product.
But that wasn't happening smoothly, was it?
Not at all. Because of mismatched invoices and just a generally overwhelmed digital system, those refunds were massively delayed.
Wait, so when small businesses cannot get their ITC refunds quickly, their working capital, like their actual cash on hand, is completely trapped by the government?
Precisely. Which is terrifying if you're running a tight margin operation.
I mean, yeah, that actively discourages smaller businesses from even joining the formal economy. Why register for GST if it just means your cash gets locked up?
Exactly. And add to that, the total explosion of the digital economy since 2017. I mean, e-commerce, gaming, crypto, gig work.
Right, those sectors completely ballooned.
They did.
Yeah.
And they desperately needed clear tax norms that the old 5-slab system simply wasn't built to process.
So here's where it gets really interesting, especially when we look at the specific mechanics of this new patch. As we said, the rollout just happened on September 22, 2025.
And the structural shift is massive.
Yeah, we have transitioned from those 4 active tax slabs down to a highly streamlined 2-slab system. The 12% and 28% slabs are just entirely wiped out.
Right. The vast majority of items have been shifted into just 2 buckets now. A 5% merit rate and an 18% standard rate.
With one major, very deliberate exception to capture the extremes?
Yeah. Yes, there is now a 40% demerit rate. But this strictly applies to luxury and so-called sin goods. Think pan masala, tobacco products, and heavily aerated drinks.
Okay, but wait, hold on. I am looking at these numbers and something doesn't add up for me.
What's that?
If you are completely wiping out the 28% and 12% tax brackets and dropping the tax on thousands of everyday items down to 18 or 5%, you are slashing revenue across the board.
On paper, yes, it looks like a huge hit.
So how does the government not just instantly go broke? I mean, consumer durables, auto parts, all getting massive cuts.
What's fascinating here is how the government is actually calculating the offset. It comes down to an economic concept you must understand to grasp this policy. It's called revenue buoyancy.
Revenue buoyancy. Okay, break that down for us.
The administration expects to prevent tax leakage not by raising rates, but through sheer simplicity and advanced compliance technology.
Oh, okay, so lower margins, but much higher volume.
Exactly. Think of it like a movie theater that decides to drop its ticket prices from, say, $20 down to $10.
Right, so on paper, they're losing $10 a ticket.
Yeah, but because the price is now so accessible, the theater goes from being half empty to completely sold out every single night.
And they actually end up making significantly more money overall. That makes sense.
Right. Currently, India has about 1.4 crore registered GST taxpayers. The entire goal of GST 2.0 is to massively expand that base.
Because lower rates and a simpler system naturally pull more businesses out of the shadows and into the formal economy.
Exactly. The simplicity itself becomes the enforcement mechanism.
You don't need a bigger stick to punish tax evaders if you just make it incredibly easy and cheap to comply.
You nailed it. And to execute this, the government's response framework operates on three distinct pillars: policy, institutions, and technology.
Let's start with policy. Beyond the two slabs, what else are they doing?
Well, on the policy front, we are seeing targeted zero GST exemptions. But policy is also tackling a massive headache known as an inverted duty structure.
Okay, let's make sure we define that because it is a critical mechanism for the exam. Imagine you run a factory making leather shoes, right?
A great example, yeah.
Under an inverted duty structure, you might be forced to pay a 12% tax on the raw leather you buy, but the government only allows you to charge a 5% tax on the finished shoe you sell.
Right, which means you are literally paying more tax to build the product than you are legally allowed to collect when selling it.
So your cash is just perpetually trapped. That is a devastating bottleneck for manufacturing.
It really is. And GST 2.0 specifically corrects this in key labor-intensive sectors like textiles, footwear, and handicrafts.
Yeah.
It effectively unblocks that trapped capital.
Amazing. Okay, so what about the institutional pillar?
This is huge.
Yeah.
By December 2025, the GST Appellate Tribunal, or GSTAT, will be fully operational.
Oh, the GST. So instead of dragging classification disputes through the regular court system for years, businesses have a dedicated fast track.
Exactly. It's a tribunal specifically designed to clear the litigation backlog.
Okay, and what about the technology pillar? Because earlier you mentioned how the old system trapped working capital due to mismatched invoices.
Right. The tech upgrade is arguably the most vital piece. They are heavily upgrading the goods and services tax network, the GSTN.
How is it different from the 2017 version?
Well, the new tech doesn't just passively store files anymore. It uses advanced analytics to automatically match a supplier's invoice to a buyer's claim in real time.
Oh, wow. Meaning what used to take months of manual paperwork and cross-checking now takes seconds.
Exactly. That frees up working capital for small businesses instantly.
Wait, so think about the agricultural sector. By dropping the tax on farm equipment to 5% and ensuring farmers and suppliers get their credits instantly via this new tech.
They aren't just tweaking a spreadsheet, are they?
No. They are indirectly subsidizing the entire agricultural sector, lowering the barrier to mechanization without actually having to write a direct government stimulus check.
That is incredibly efficient. And, if we connect this to the bigger picture, you are hitting on the most crucial analytical takeaway of this entire transition.
Which is what?
India is shifting away from using GST merely as a blunt revenue collection tool. It is now wielding the tax code as a strategic lever for broader governance and social engineering.
That perfectly explains the zero GST exemptions on life and health insurance, including term, UIP, and family floater policies.
Yeah, how did you read that initially?
When I first saw that, I just thought, oh, great, a middle-class tax cut. But it's not just a tax cut, is it?
Not at all.
It's practically a targeted public health intervention.
Precisely. By making essential medicines and health insurance zero GST, the government is drastically lowering the cost of healthcare access.
It strengthens the safety net for beneficiaries under massive social schemes like Ayushman Bharat.
Right. It is inclusive growth, engineered entirely through tax policy. And when you simultaneously cut GST on small cars, consumer durables, and cement, you directly boost household savings.
And those families take that saved money and spend it, which stimulates domestic demand, drives GDP growth, and boosts domestic manufacturing.
Exactly. It is a massive interconnected loop.
So we have the national economy benefiting from boosted domestic demand, agriculture getting a stealth subsidy, and society benefiting from health insurance exemptions acting as a safety net.
It sounds brilliantly cohesive, right?
It does. But I have to push back again here.
Go for it.
Earlier, we briefly mentioned building trust between the center and the states. But if we are slashing rates to stimulate the economy, someone has to take the initial financial hit.
Yes, absolutely.
And aren't industrialized states anticipated to face a much sharper revenue loss because of these cuts?
This raises a really important question, and honestly, it is the primary critical evaluation you must make when looking at this policy for the exam.
Okay, so I'm on the right track.
You have identified the exact structural fault line of GST 2.0. The central tension is balancing these growth-oriented measures with strict fiscal prudence.
So explain exactly how that fault line works. Why do industrialized states get hit harder?
It comes down to understanding that GST is a destination-based consumption tax.
Okay, destination-based, meaning what, practically?
That means the tax revenue goes to the state where the product is actually consumed, not the state where it was manufactured.
Got it.
So let's say a car is manufactured in an industrialized hub like Tamil Nadu, but it is ultimately purchased by a consumer in Bihar. Under the destination-based rules, Bihar gets the tax revenue from that sale, not Tamil Nadu.
Ah, I see. So industrialized high manufacturing states are already exporting their potential tax revenue to high population consumer states.
Exactly.
And now, on top of that, GST 2.0 is slashing the tax rate on those manufactured goods from 28% down to 18%. No wonder they're sweating.
Right. While a general consensus was reached in the GST Council to pass this, those industrialized states have expressed significant vocal concerns.
I mean, a sharper revenue loss complicates all subsequent fiscal equity negotiations between the center and those states.
The reality is, if that revenue buoyancy we talked about doesn't happen fast enough, if the movie theater doesn't sell out quickly, both central and state governments are going to face a temporary revenue ditch.
Which means states might be forced to adjust their expenditures.
Yeah, they might have to cut into critical developmental budgets, like building roads or schools, just to balance their books in the short term.
And we cannot ignore the operational constraints either. Moving from 4 active slabs down to 2 sounds simple, but in practice, you are legally reclassifying thousands upon thousands of items.
Oh, the logistics are staggering. Even with the GSAT tribunal coming online in December 2025, there's going to be a massive initial wave of disputes.
Right, over whether a specific nuanced product is a 5% merit good or an 18% standard good.
Plus, the strain on the technology itself. The GST and infrastructure is going to be processing an unprecedented volume of reclassifications and handling those promised real-time refunds.
And if the servers crash or the analytics fail, the working capital of millions of businesses freezes again.
Exactly, which is why operational constraints are inextricably linked to fiscal stability here. The structural genius of GST 2.0 is clear, but the fiscal landmines are very real.
Okay, so we have mapped out the mechanics, the strategic genius, and the very real structural fictions. Let's pivot to the exam preparation side of the war room.
Let's do it.
If you had to explain the core of GST 2.0 to a CEO in an elevator, or if you were drafting a high-level answer for this, how do you structure it? What are the non-negotiable pillars?
If you are structuring a professional brief or an exam answer on this, you frame it around 3 action-oriented pillars. First, institutional strengthening.
So ensuring the GStat is ready.
Yes. You must highlight the necessity of ensuring that GStat is fully empowered and heavily staffed by its December 2025 deadline to absorb that inevitable shockwave of classification disputes.
And the second pillar?
Second is capacity building. The GSTN digital infrastructure requires continuous, aggressive upgrades to prevent any operational bottlenecks that could trap MSME capital during the transition.
And the third pillar has to be about future-proofing the system, right? Dealing with those digital economy sectors we mentioned earlier.
Exactly. Third is regulatory clarity. The government must issue immediate, unambiguous classification guidelines for new age sectors.
Like gig work platforms, cryptocurrency transactions, and online gaming.
Right. Because if they don't clearly define where these fall on the 18% or 5% brackets right now, they risk drowning the new tribunal in entirely preventable litigation.
Okay, so what does this all mean for your revision? Let's do a rapid-fire breakdown.
The essential memory anchors.
Right. When this gets debated, or when you sit down to write, you need these facts in your back pocket. Fact 1. The rollout already happened on September 22, 2025.
Fact 2. The complex web is gone. We're now operating on a two-slab system, 5% and 18%, backed by a 40% demerit rate for luxury and sin goods.
Fact 3. The safety valve for disputes, the GStat, becomes fully operational in December 2025.
Fact 4. The zero GST application to health and life insurance is not just a tax cut, it is a vital public health subsidy.
And fact 5. The ultimate success metric isn't just immediate revenue, it's expanding the tax base far beyond the current 1.4 crore taxpayers.
Spot on. And when you are synthesizing all of this, keep your ear to the ground for 5 critical analytical keywords that define this entire reform.
Let's hear them.
First, revenue buoyancy, the idea that lower rates drive higher volume. Second, destination-based tax, the reason manufacturing states lose revenue to consumer states.
Third is inverted duty structure, right? The bottleneck where raw materials cost more in tax than the finished good.
Exactly. Fourth is merit, and demerit rates the moral and economic categorization of goods into that 5% or 40% bucket. And finally, fiscal equity.
The delicate balancing act between the center and the states.
Yes, those concepts are the bedrock of understanding modern Indian economic policy. But as we wrap up this analysis, there's a much broader implication here.
Oh, what's the final thought for the war room?
Well, we've spent this time analyzing how GST 2.0 relies on the premise that simpler, cheaper rules will naturally pull millions into the formal economy, right? And that generates massive data trails.
Yeah, it creates the ultimate digital footprint for businesses.
Exactly. Which leaves us with a rather profound strategic question to mull over. If GST 2.0 succeeds, if it proves beyond a doubt that a simplicity drives compliance model expands the indirect tax base while simultaneously tracking everyone's financial footprint,
Wait, are you suggesting what I think you're suggesting?
could this exact framework become the blueprint the government uses to finally completely overhaul India's complex direct income tax system next?
Oh, wow. Now that is a structural shift worth watching. The transition from indirect goods to direct personal income.
It is the logical next step.
We'll keep that in mind as you process everything we've covered today. Study hard, and we'll see you in the next deep dive.